Welcome back to You Heard It From a CFP. My name is Matthew Coyle. Today we're going to talk about the long game. It's not a fun time to own stocks right now, but we persevere and we remember why we do this in the first place. Let's dive in. Well, back in the office again here in downtown Minneapolis. Always nice to be back in my office. Today we're going to talk about the long game and why investors always should focus on the long term. And you know what's going on in the world at the very moment today actually kind of dovetails nicely with this video, which I was going to do anyway. As I record this video, literally as I record this, Russian tanks are rolling into Ukraine, interest rates are rising, the cost of everything is pretty much going up across the board, in most cases anyway. And it's just kind of a tough time to be an equity investor. Let's just be honest with you. It hasn't been a great 3 months, or 4 months really. So let's do 4 reasons why you should be focused on the long game, what to remember when you're building investments, go back to basics. Why are we doing this? What does the long-term picture look like for you? We'll start with number 1. I sense some math coming. All right, let's do some simple math. You have to understand when you are investing, what are you doing? What's the curve supposed to look like? And historically, what could you expect? So I'm going to keep the math very simple. You start off with $1,000 in an investment account, just a broad-based stock market fund. If it has to be that, that's fine. You add $500 a month to that. You do this for 10 years. You earn it 7%. And thanks to our friends at investor.gov here, you'd have a little under $85,000. Just nearest makes a little difference. $85,000 by the time you're done with that. Now, you do this for 20 years at a reasonable rate of return, which again, 7%. It's fairly reasonable to assume for a stock market investment. And you're about $250,000, okay? You change this to 30 years, and you are about $575,000. Point being, investments never grow in a straight line. They only grow in a curve. That is how the mathematics of investing work. It's how the mathematics of any investment works. The longer you wait, the longer you invest, the more you will see the fruits of that labor as the curve develops. You cannot enjoy the end of that curve unless you fund at the beginning of the curve. So invest as early and as often as you possibly can. So anyone that I work with, any client, any plan participant, anyone who comes to talk to us about this is one of the first things I will show them at a basic level is, look, investments never grow in a straight line. They only grow in a curve. You have to remember what it is you're buying, okay? Unlike investing in savings bonds or treasury notes or cash investments in a bank, what have you, there just isn't a fast enough rate of return to generate that curve that you need to generate the money you'll need later in life. So mathematically speaking, you have to give it enough time. That means investing in up markets and down markets. Down markets in particular, because they are basically a fire sale, if you want to call it that. You'll get everything a little bit cheaper, you'll add a little bit more to your balance, and then when things pick up, as I'm going to show you in the next little part here, when things start to pick up again, the investment return during that period is actually fairly good historically. So let's do that now. Let's talk about what historically happens in bear markets and bull markets. All right, so how does the market perform in an average bear market and an average bull market? Absolutely fantastic chart that was tweeted out not too long ago here from First Trust. History of U.S. bear and bull markets since 1929 through 2021. Absolutely love this chart. Average bull market was about 2.7 years, 112% cumulative total return. Average bear market, loss of about 35%, which is painful, don't get me wrong, and lasted about 9.5 months. Now, we are not in a bear market by any stretch of the imagination yet. We're definitely in a correction, and things are a bit tough out there right now. However, bear market by definition, we're not there yet. I think total loss is around 10% for the start of the year, and the S&P somewhere in that neighborhood. However, it is a far bigger mistake to miss an upcoming bull market because you are trying to time your way out of a bear market and avoid a bear market. Far bigger mistake to miss a bull market than it is to have to endure a bear market. It's far better for you to simply ride the course. Now, if you are uncomfortable with the level of volatility in a portfolio, and you have dedicated purchases coming up, like a home purchase or a definite need for some income in retirement, then perhaps it's a good time to sit down with a planner, someone like myself or an advisor that you work with, and just say, look, where's the risk in my portfolio? I think I'm taking too much. Let's change things up. Or perhaps you just want to reassess your goals and go from there. But it has historically been a far bigger mistake to miss a bull market than it is to have to endure a bear market. Bear markets are not that long. They are painful, but they don't last that long. They're fairly sharp, and bull markets are far longer, and they return a much greater amount to you in the long run in order to build that curve I talked about earlier. So do not try to spend a lot of time missing a bear market. If you want to be tactical, that's fine. Maybe take a little risk off the table. But jumping into the market, into cash, back in the market, back to cash, that typically is not going to do much for you. It's just going to cause you to miss. The start of what can be a very, very powerful move in the market. And don't forget also that Actually, over half of the most powerful up moves in a market over the last 20 years have actually been during down bear markets. So during down periods, you get these really big, violent up moves in markets that can add to your portfolio. Don't miss those by trying to time everything all the time. So keep in mind historically what bull markets and bear markets have done. All right, let's talk about your goals. The whole purpose we invest to begin with is to achieve goals. And we spend a lot of time and a lot of money, frankly, investing in systems and people to help you understand that over here. So typically when you sit down with a planner, whether it's me or anybody else, they should be taking the context of your goals in the context of your investments and trying to match those two up and trying to get some type of allocation that understands, this is where I want to be and this is the risk I'm willing to take to get there. If the current market environment is a little bit, if it's making you uncomfortable, if you lose sleep, if you can't think about anything else, for example, then it's very possible you just need to be in a different allocation, or maybe you need to sit down and talk with an advisor about what you should or should not be investing in. We do that all the time with our clients. What we do is we can run concurrent scenarios in our planning software based on different rates of return and what your goals are and what your allocations are and what the returns on those allocations are likely to be and when you're going to draw Social Security and what extra income you might have in retirement and what you're going to be doing when you retire and how long that is going to be. How long even maybe you think you might plan to live if you can take an estimated guess at that too. So there's a lot of factors that go into buying investments, and it's not just selecting investments. It's selecting investments within the context of what you want to do, where you want to be, and how much risk you're willing to take to get there. If you are an investor with over 10 years of time horizon, you should be the majority in the stock market. If you have under, let's say 10 years to a goal that you want to have, or maybe you're buying a house, or maybe you have a lot of money that's due for a college education, or something is coming up that is definite, and it's within, let's say, 3 years, that money should not be in the stock market at all. It should be in guaranteed accounts, or perhaps it should be in very low volatility bond funds or something like that, which just won't see as much volatility as what we're seeing right now. So, number 3, stick to your goals, understand what it is you want, and have a conversation with someone about that. Okay, so what are some things you could do right now in a down market that would make a big difference for you? Okay, so there's a few things you may want to consider as I kind of wrap things up here. So, number 1, if you can increase your contributions to your 401k plan, to an IRA, to a Roth, whatever, especially a Roth or an individual plan with a lot of tax benefit to it like that, try and do it if you can. Try and find those extra little things you can do as far as increasing the contributions. Like I mentioned earlier, rebalance the portfolio. If you think you're taking too much risk, sit down with a planner, talk about it, okay? You may want to consider doing a Roth conversion as well. When stocks are down, we typically see a few more Roth conversions than we typically see when stocks are rising, simply because you can convert a little bit more of those shares. They're cheaper. You don't have to recognize as much as the tax income from doing the conversion, right? And you get a little more into that Roth, and then eventually when the market turns back up, it turns to be in your favor simply because you were able to put more shares in the Roth than you would have when stocks are more expensive. So consider doing a Roth conversion. If you want to have information on that, feel free to reach out. The other thing I would consider probably doing is maybe doing some tax loss harvesting. If you've got other gains that you may have to recognize this year from a tax standpoint, maybe sell some losing positions in an account and just offset those gains so you can regroup and reinvest. So tax loss harvesting definitely would be an idea. Maybe gift some shares to someone else if you want to start a gifting plan, do that. And then again, just make sure your goals are on track. Don't be afraid of bear markets. Again, they're very short historically. And the effort in trying to miss them is going to be is not going to prove fruitful because you're probably just going to miss the upturn because most really big days in the market happen after really bad days. That's just a fact of it. So those are some things I would consider in the current market environment. Keep your head up, keep investing, understand the bigger picture, and I will talk to you again very soon. Don't forget though, the most important asset you have is your time. Take care of yourself, take care of your family, and I'll talk to you again soon. Thank you very much.